For most of modern history, inflation was feared. Money was expected to hold value, not stimulate growth, not support policy. Stability was the goal. At the beginning of the 20th century, most major economies operated under the gold standard. Currencies were tied to something physical. Gold limited how much money governments could create. That limit mattered. If a government spent too much, gold reserves fell. If prices rose too fast, confidence collapsed. Inflation was visible, and visibility made it dangerous. In the 1,920 seconds, this logic still defined the system. When inflation appeared, it was treated as failure, a signal that discipline had broken down. The most extreme example came in 1923. In Weimar Germany, the government printed money to cover war debts and domestic obligations. Prices doubled in days. Savings disappeared. The currency lost meaning. The lesson was unmistakable. Inflation destroyed trust faster than default. And once trust was gone, no policy could restore it. For decades, this memory shaped decision-making. Money was not a tool of adjustment. It was a constraint, until history forced that constraint to break. War broke the system that discipline had built. During the Second World War, governments faced a problem no gold standard could solve. The scale of spending was too large, the speed too fast. Factories had to run continuously. Armies had to be supplied across continents. Weapons had to be produced before taxes could be collected. Gold was not flexible enough. Between 1,939 and 1,945, government debt exploded across the industrial world. In the United States, federal debt rose from under 50% of GDP to more than 120%. This was not an accident. It was necessity. Money was created to fund survival, not growth, not comfort. Inflation appeared, and this time it was tolerated. Not because it was harmless, but because losing the war was worse. Price controls were imposed. Rationing followed. The state intervened directly. Markets no longer set outcomes. They were managed. When the war ended, the system did not return to its old rules. It could not. Too much debt existed. Too many promises had been made. The lesson was subtle but permanent. Extraordinary conditions justified extraordinary monetary behavior. And once that door opened, it never fully closed. Inflation had proven something important. Under enough pressure, discipline could be suspended, and survival came first. After the war, the system tried to repair itself. In 1944, 44 countries met in Bretton Woods. The goal was simple: restore discipline without repeating collapse. Currencies were tied to the US dollar. The dollar was tied to gold, $35 per ounce. This was not a return to the old gold standard. It was a compromise. Governments wanted flexibility. Markets needed limits. Inflation was still feared, but control was now centralized. Capital flows were restricted. Exchange rates were fixed. Monetary policy became coordinated. For a time, it worked. Trade expanded. Reconstruction accelerated. Growth returned. But the system carried a flaw. The supply of dollars depended on U.S. deficits. The world needed liquidity. The United States needed discipline. It could not provide both. By the 1,960 seconds, dollars circulated far beyond the gold backing them. Confidence replaced convertibility. Foreign governments began to notice. Gold reserves drained. Trust weakened. The system still functioned, but only as long as no one tested it. Bretton Woods preserved stability by postponing conflict, not by resolving it. Inflation was restrained, but the constraint itself was becoming fragile, and fragility always waits for pressure. Pressure arrived in 1971. For years, the United States had financed global stability by running deficits. Dollars flowed outward. Gold reserves thinned. Foreign governments held more dollars than the U.S. could redeem. The system relied on trust, and trust was weakening. In August 1971, the link was cut. The dollar was no longer convertible into gold. Not temporarily, permanently. The constraint disappeared. This was not presented as a revolution. It was framed as necessity. But its consequences were structural. Money was no longer limited by reserves. It was limited by policy. Inflation stopped being a failure of discipline. It became a variable to manage. The 1,970 seconds revealed the cost. Oil shocks, rising prices, stagnant growth. There was no anchor to return to. From that moment on, stability depended on credibility, not convertibility. Money no longer represented stored value. It represented confidence. And confidence required constant management. By the 1,980 seconds, the system faced a new reality. Debt was no longer temporary. It was structural. Governments carried obligations that could not be repaid honestly. Not through growth, not through taxation. Inflation offered an alternative, not a solution. A delay. By allowing prices to rise, real debt shrank quietly. No votes. No defaults. No announcements. The cost was spread across time. Central banks adjusted rates. Governments rolled obligations forward. The system stayed intact, but discipline had changed form. Money was no longer constrained by reserves. It was constrained by tolerance. How much inflation could societies absorb before trust weakened? That question replaced repayment. Debt no longer demanded resolution, only continuity. The system did not aim to end imbalance. It aimed to manage it. And management required credibility. As long as confidence held, the structure survived. But survival now depended on erosion, not correction. Control shifted quietly. Central banks no longer tried to eliminate cycles. They tried to smooth them. Interest rates became the primary lever. Not to reward saving, but to manage time. When growth slowed, rates fell. When stress appeared, liquidity expanded. After 2008, this logic became permanent. Rates approached zero. Balance sheets expanded. Extraordinary measures became standard tools. The goal was not prosperity. It was continuity. Markets were not allowed to fail suddenly. Failure had to be managed. Delayed, absorbed. Time replaced discipline. Losses were spread forward. Reckoning postponed. The system stayed functional, but only by borrowing from the future. Money no longer signaled scarcity. It signaled policy intent. Stability became a performance. And the longer it continued, the more dependent the system became. On constant intervention, there was no exit plan, only maintenance. Over time, inflation changed its role. It was no longer treated as a risk. It became a feature. Prices were allowed to rise, as long as they rose slowly. Wages lagged. Savings eroded. Debt became easier to carry. The burden shifted quietly, not through law, not through votes. Through time, inflation redistributed costs without assigning responsibility. Those with assets adjusted. Those without absorbed the loss. The system called it stability. Governments avoided hard choices. Central banks protected confidence. Markets continued to function. But the structure depended on acceptance. As long as inflation felt manageable, trust survived. When it accelerated, tension returned. The policy had limits. Inflation could delay consequences. It could not erase them. And once it stopped being invisible, it stopped being neutral. What was once extraordinary became normal. Inflation stopped feeling temporary. It became expected. Systems adjusted around it. Contracts assumed it. Policies relied on it. Stability was no longer defined by balance. It was defined by continuation. As long as markets moved, the system was considered healthy. But continuity has a cost. Trust erodes slowly, not in collapse, but in accumulation. Money loses precision. Signals blur. Time becomes distorted. Each intervention buys stability today. By borrowing clarity from tomorrow, the system survives. But understanding weakens. Inflation does not announce a breaking point. It stretches it. And when trust finally absorbs too much strain, the correction is never gradual. The uncomfortable truth is not that inflation exists. It is that modern systems require it, not to grow, not to prosper, but to remain standing. And no system that depends on erosion can do so indefinitely.